Hello and welcome to this Astranti YouTube video on modern performance measurement. This is part of various different videos that we're going to be posting, some related to the case study, some related to objective test exams, both content-wise and also from a technique standpoint, how you approach the exam. And if you like this video and you would like to see more of them and you want to be kept up to date on when we are going to be releasing those other videos that I've already spoken about, then please like the video and subscribe to the Astranti channel below. So in this video, we're going to look at one of the key bits from the P2 and E3 syllabus. And this is about modern performance measurement, how we are looking to adapt how we analyze the performance of an organization within the modern era. And the reason for modern performance measurement is based on the idea that traditional methods are limited. They just look at the facts and the figures. They don't necessarily give a real indication of how the business is performing from a more holistic way. And that's why we have more modern measures to provide more real analysis, to look at the true benefit to the organization. If that sounds complicated or you're not quite clear, don't worry. I hope that it will all become clear very soon. One of the main ways of doing this is by looking at economic value added. And what economic value added is essentially a way of looking at the true benefits, the additional long-term benefits to the organization of undertaking a particular project. If we look back at the return on investments, we look at the residual income, some of the problems with those methods were that they were short-termist in nature. And as a result, managers of departments, managers within organizations may sacrifice long-term sustainability for short-term growth because they are being judged on their short-term performance. In the return on investment section, we saw that a manager may not want to undertake a project that was actually profitable to the organization as a whole purely because in the short term it would have affected their return on investment. Their return on investment percentage would have decreased. And that's a lot of the reasons for something such as economic value added. It looks at the other factors that will benefit the organization in the future. So for example, if you are going to spend money investing in a new piece of machinery or in some staff training. Now, the costs of these may reduce your profitability in the short term, and they may make the particular project that you're purchasing the machine for, that you're training the staff for, to look unprofitable. But actually, you're going to be able to take those positives forward and apply them to the business as you go forward. And this is an internal measure generally taken by the accounting team, by management accountants such as yourselves within the organization. So in short, we are adjusting our profits based on these additional qualitative factors that are going to provide some sort of real economic benefit to the business in the long run. And we can calculate our economic value added by undertaking a three-step process, starting of course with step number 1, which is to add in additional expenditure. So we'll use an example to illustrate this. Let's say that we have a project and that project is profitable to the tune of £1 million. Now, if we're judging them just purely on the profit generated, we'd stop there at £1 million. But the costs involved included spending $400,000 on research and development and $200,000 on training staff. Now, if we're just using a traditional method here, we would just rule those out as costs, and it would reduce the profitability. But we're going to benefit from that $400,000 we spent on research and development. Things rising from that will be taken forward to new projects. We're going to benefit from having better trained, better equipped, better skilled staff. So we have to add that expenditure as something that is actually good for the business. We have to add it to the profit because we are going to see actual tangible benefit from that. And this gives us a new profit figure of 1.6 million from this project. Next thing we do is we add back non-cash accounting adjustments. And a good example of this could be adding in bad debts. Now, standard accounting has provision for bad debts that's written off of income. And the key word there is provisions for bad debts. It's the likely scenario, but it's not the absolutely definitely going to happen scenario. It's a provision for bad debts. So if that provision is never realized, if we never have to actually write off that 200,000 as bad debts, then it would be unfair to criticize the manager because it's not actually costing the organization anything. They're in a sense being assessed on pure accounting rules and accounting provisions rather than actual performance. So if we have that 200,000 in bad debts, we need to add that back in because that's not actually reflective of their performance. And the final step is to subtract the cost of capital on an asset because an organization's profit must cover the cost of capital. If an organization's profits are not covering the cost of capital, then shareholders are not earning a fair return. And if shareholders are not earning a fair return, they may take their investment elsewhere. So let's say that the organization has got assets of 10 million and a cost of capital of 10%. Now 10% of 10 million is 1 million, and so a return of 1 million is needed to ensure a fair return to shareholders. And we take this into account in our calculation by deducting it from our economic value added, giving us at last our EVA figure of 0.8 million. Now this is the economic value added to the organization in excess of the return provided to shareholders. So this is the actual long-term economic benefit of undertaking this project to the organization. So, quick summary here that the EVA is an estimation of the value created in excess of the return required to shareholders. So we've taken into account our 1 million cost of capital, but we've also taken into account that 0.4 million investment in research and development and that 0.2 million investment in training staff, which if we had used a traditional method of assessing profits, we wouldn't have taken those into account. And it's worth noting that the capital figure, so in our example it would be this 10 million here, is the net assets on our balance sheet adjusted for various accounting items that are not relevant for shareholders. Now, you don't need to know how to calculate that for your CIMA P2 exam, but just be aware that there is such a thing. And we'll finish by quickly summarizing this calculation here. Just to reiterate the process, the economic value added is the profit plus expenditure on long-term value and non-cash items such as investment in research and development and investment in training staff minus the capital employed multiplied by the cost of capital. So in our example, that was the 1 million figure. So we just run through the calculation. 1 million profit plus 0.8 in expenditure minus 1 million for the cost of capital, and that gives us our 0.8 figure for the economic value added. And as good as this is, there are of course disadvantages, such as the fact that judgment is required here. Is 0.2 million in training for staff really going to benefit the business in the long run? What if they're being trained in things that are only going to be utilized purely in that project and will be of no benefit going forward? What if the new skills that they have been trained in make them more employable to rival companies and then they leave the organization? That won't actually be of long-term benefit to the organization. Identifying the cost of capital is always very difficult to do correctly, particularly if it's a new project. Sometimes you have to do a higher cost of capital for a new project as a result of the inherent risk involved. It's also an absolute measure, so a bit like residual income. It's a measure on pure out-and-out income, out-and-out profit, as a figure rather than as a proportion of the amount of money invested or anything like that. And it doesn't take into account necessarily the fact that comparing two divisions of different sizes is going to be difficult to do in an absolute measure, unlike return on investment, which was useful and could be used to compare the true performance of the managers in different size divisions. Also, just a section here on how it relates to decision making. The reason why economic value added is good is it provides a more meaningful analysis than perhaps traditional performance measurement systems do, because it takes into account factors that are going to benefit the organization, that are going to add long-term value to the organization, rather than just focusing on the short-term profits or the short-term revenue. It's also very useful and meaningful in that it allows an organization to appropriately appraise the performance of a manager, because it looks at factors that those managers can control, that they are in direct control of, and so it allows them to appraise the performance that they are actually and specifically responsible for. It's harder to manipulate as well, because it removes a lot of accounting practices and standard accounting principles that organizations such as Enron and companies like that in the past have used to manipulate their profitability, to manipulate their productivity. And it's useful for investors as well, as it gives them another comparison, another bit of information to use in addition to traditional profit, to traditional capital figures, another way of analyzing the business to see whether it is an appropriate investment opportunity. Second modern performance measurement technique is the cash flow return on investment. Now, this is based off of more traditional methods. I mean, cash flow is not a new concept in accounting. It's been around as long as there's been accounting around. But where it differs is that cash flow return on investment is based on projected cash flows to calculate yield. So while forecasting cash flows in itself is not a new concept in management accounting, it isn't normal at the moment to use forecast figures in the arena of performance measurement. And so this, in a sense, represents a step forward where we're using future figures to judge current performance. And so general current thinking when it comes to performance measurement is that there are good bits, there are bad bits, etc. But how is it best to truly align the interests of both the managers and the stakeholders? Because often these can be in contradiction to each other. If we've got perhaps a manager who's got to try and cut costs as much as possible, but by cutting all these costs they reduce the revenue and that reduces the profit for the business as a whole, then that's not very good. That's not going to help maximize shareholder value. And as a result, targets can often find themselves at odds with each other, particularly when it comes to the short term and the long term. If you have directors at an organization who are in charge of trying to achieve a better profit figure in the next year, and if they get that better profit figure, they'll all get big bonuses, they're going to want to try and leverage everything they can to try and get that short-term profitability up. And that, of course, is going to be bad for the business as a whole. One way in which modern thinking has tried to address this situation is by executive share options. So what is an executive share options? Essentially, it's where the directors get given shares in the organization. So, for example, if we're managers and we've got shares or options to purchase shares in the company for £100 in 5 years' time, and the current share price is 90, then it's best to get that share price up as high as possible. In fact, get it really high so that if it's in 5 years' time it's worth £120 and we can purchase them for £100, then we can buy all those shares and instantly make a £20 profit on every single share. And that will enable the managers, or will enable the company to try and get the managers, get the directors to push the share price up as much as possible. And the fact that it's from 5 years' time means that we're trying to secure growth in the long term. And this goes some way to overcome that issue of short term versus long term. The managers, the directors then need to be working towards a long term goal, sustain the business in the long term. Again, tying all of this background to that ultimate purpose of control theory, keeping a business running in the long term, keeping it sustainable.